So today we are lucky to have Harold James. Harold is the Claude and Lord Kelly Professor in European Studies here at Princeton in the History Department and in the Woodrow Wilson School. Harold also runs the program in Contemporary European Studies here at Pierce. He's a member of the Pierce Executive Committee. I should probably mention also that it was originally Harold's idea that we hold these sessions. It was a brilliant idea and has gone off well. But Harold has published a marvelous book that's recently come out. He's got it right here. I'll hold it up. Called Making of the European Monetary Union. Very timely book, obviously, on a subject that affects us all. So let me turn it over to Harold to talk about his book, and then we'll open it up for questions.
Well, thank you so much, Mark. It's really great to be here and to be able to talk about this book. First of all, maybe I should say something about how this book originated, because it's actually the oddest story in terms of the way that I got to write a book of any of the books that I've ever done. I was looking on a Saturday morning at The Economist, and there was an advertisement in The Economist for asking somebody to put in a tender to write a book on the, it sounded unbelievably complicated, on the history of the Committee of Central Bank Governors of the member countries of the European Economic Community. You know, that practically took up a whole page advertisement in The Economist, just putting that title. And I thought this sounds absolutely lethal. And then it struck me when I thought about it for a moment that actually it was really very, very interesting, and that this was the story of how the Europeans came to create the European Monetary Union. So I did all the things that the advertisement told me to do, and I logged on and I sent in a CV, and then there was an interview. And then I was selected by the European Central Bank and the Bank for International Settlements in Basel to write this book. And the plus about it was that as a result of this agreement, I got access to an amazing range of documents from the 1960s to the middle of the 1990s, from the predecessor of the European Bank, this Committee of Central Bank Governors, from the European Monetary Institute, that was the immediate predecessor of the European Central Bank, but above all from the national central banks that negotiated about all of this. The Bundesbank above all, because the German central bank was really a central player in this, the Banque de France, the Banca d'Italia, the Bank of England, and so on. And so, in a sense, what I've done in the book is to give a kind of inside perspective of the negotiations and the calculations and the reasons why this extraordinary experiment in monetary union was made. And it really was a quite extraordinary experiment. I remember in the 1990s, there was a interdisciplinary seminar in the Mellon-Sawyer series that was organized in Princeton. One of the chief figures in that was somebody who was then in the Princeton Econ department, Ken Rogoff, who's now went via the IMF to Harvard. And I always remember the way that Ken started this discussion on the European Monetary Union, which was then just about to come into effect. Formally, it started in 1999. And Ken said, you know, this is an absolutely crazy thing. I can't really believe that the Europeans are crazy enough to do this. But on the other hand, as a social scientist, I'm very, very pleased to see this big experiment and to see how it will actually unfold. And we've obviously been seeing the unfolding of this big experiment. So let me just sketch out briefly the conclusions of the book. One of the things that struck me really quite early on was that there were some myths about the European Monetary Union, myths about the euro, and one of the things historians always like is dismantling myths. And it struck me that dismantling the two big myths that are circulating around the euro was not only something that was a valuable scholarly exercise, but that it was also something that would be a valuable contribution to debates about the euro, because these myths are so pervasive, they're so widely held, and much more widely held since the beginning of the euro crisis. And the fact that they're so widely held really actually helps to poison the political atmosphere and make a rational outcome, a rational solution to the problems of the Eurozone much harder. One is really what Ken was adumbrating in this comment in Princeton in the 1998 or 9 seminar, that the euro was fundamentally always a political project, and that it lacked any sensible economic rationale altogether, that it was driven from beginning to end by politics. And that's a story that's widely advanced, both by people who were really central to the project of making the euro and played a central role, like the German ex-foreign minister Hans-Dietrich Genscher. And it's also a view very, very firmly held by critics of the euro. So Marty Feldstein, for instance, always makes this point, that this was a political project and it wasn't very well thought out economically. Why was it a political project? The fundamental goal, according to this theory, both by Genscher and by Feldstein, both in the positive and the negative version, was that the euro was supposed to cement peace in Europe, and it was meant to make a world war of the kind that had devastated Europe in the first half of the 20th century completely impossible. But this is obviously very, very peculiar if you live in North America, because we've had wars in the 19th century with Mexico, and we've had wars with Canada, and nobody thinks that we should have a monetary union with Mexico or Canada to stop us invading them. But I don't think anybody really believes that there's a serious likelihood of there being a war with Mexico or Canada. So it looks slightly odd as a rationale. And I'd quite like to come back to that a bit later. The second myth about the euro is that, yes, it was also a political project driven fundamentally by Germany. The first version is often said to be an outcome of German idealism and high-mindedness, of wanting to avoid the kind of miseries that Germany had inflicted on the continent in the first half of the 20th century. But the second version says this is an attempt to get a German domination of the continent. And this has been around for a long time. It was, I think, first sketched out, really, by the former British Finance Minister, Chancellor of the Exchequer, Denis Healey. And the idea is that Germany had a lower rate of wage inflation than its neighbors did. And so any kind of system that would lock Germany into a fixed exchange rate system would give gradually more and more competitive advantages to Germany, and so that the German export surpluses would increase, and the neighbors would buy more German goods, and Germany would acquire more assets, but Germany would get employment at the expense of the surrounding territories. So this is something that Dennis Healy thought about in the 1970s when he was making a critique of the European monetary system. It comes back as a kind of criticism in the 1980s of the European monetary system, and it comes back very massively in the wake of the emergence in the 2000s of a real competitiveness gap between Germany and other North European countries and Southern European countries, and even a gap with French labor costs. So this is a excuse me. This is a story that has the bad Germans driving things rather than the good Germans driving things, as in the first version. But it also seems to me that this is really a kind of myth, and that if you really thought of this seriously, it would be completely counterproductive, because what you would be doing is getting a kind of temporary prosperity at the expense of your neighbors, a kind of beggar thy neighbor prosperity. And as a result, it really wouldn't be sustainable, and it would lead to impossible pressures. And indeed, those pressures existed in the past and were precisely the reason in the late 1960s and in the late 1970s, when there were also German export surpluses and German current account surpluses, precisely the reason that people wanted to move ahead with some kind of scheme for a monetary system in Europe. So this would, I think, really be a short-sighted version of what Germany's interests would be. And in a sense, it's not any more sensible to do that than to have the various schemes that the Germans thought out in, say, 1914 with the Schlieffen Plan to dominate Europe. It just doesn't make much sense as a long-term strategy. So what is it that the euro was really designed to do? And there, the answer that I give is fundamentally based on a mixture of looking at the discussions, but also on the chronology of this, because the crucial events and the period that is most thickly described in the book is the period in 1988 and 89, when a committee composed mostly of central bankers, under the chairmanship of the Commission of the President of the European Community, Jacques Delors, made a blueprint for the realization of monetary union. And the critical thing about this is that the Delors report came out, was published in April 1989, at a moment when nobody, at least in Western Europe, in Bonn, then the German capital, or Paris, or London, was thinking about German unification and the collapse of communism. Maybe some people in Moscow or Washington were thinking about this, but the Germans were definitely not thinking about this in April '89. And the question of the end of the Cold War, or this kind of geopolitical shift, just doesn't come up in the discussions of the Delors report. It's very, very specifically addressed to a different sort of problem. And that problem is an international one of big imbalances and big strains produced by the declining position of the US dollar. And that actually is the long-term story of this, that at moments when the dollar seemed to be under pressure or losing its position as the major international currency, the key currency on which the whole international monetary system was built after the Second World War, at those moments, that produces automatically big strains in Europe among the European currencies. In large part because as capital flows increase, they go into some countries but not into other countries. Above all, they go into Germany, and they drive the value of the mark up against the neighboring currencies, and that creates strains in an economic union at first a customs union, that's supposed to provide for the exchange of goods within Europe. So every time the dollar collapses, there's a strain in Europe. And so at the various moments when the dollar is weak, in the late 1960s, again in the late 1970s, again in the late 1980s, there's a move to make a closer coordination of policies in Europe, including, in the end, in the late 1980s. This discussion of the adoption of a monetary union rather than the fixed exchange rate system that had preceded the monetary union. What struck me as being particularly interesting in the light of what happens after the establishment of the monetary union is that the Delors Committee and the central bank committees afterwards that made the move from the blueprint for a monetary union to the actual implementation of it, to drawing up the ECB statute, the statute of the European Central Bank, that they really pinpointed some critical features that emerge really only with the financial crisis after 2008 as central flaws of the European Monetary Union. So this question, did people know in advance that there were some problems with it? The answer unambiguously, if you look at the historical evidence, if you look at the documents on this, is yes, there was an acute awareness of the major problems that could exist in a monetary union. Basically two. One is well known and is often discussed. And the other, I think, is less well known, but should be better known, and really is, I think, the number one flaw of the system as it actually emerged. The first story is, do you need some kind of agreement or limitation on the fiscal side to stop an explosion of government debt that may raise the prospect of a default on government debt or incapacity to pay? Because in the new monetary union, unlike in a country where there's a central bank and a government, the governments are borrowing in a currency that they're not directly capable of controlling. So we don't really think of this as a problem in the United States or in Japan or in the United Kingdom, but it clearly is a problem in the European setting. So if you do this, don't you need some kind of fiscal rule? The discussion there is very clear. In the Delors Committee, the figure is already laid out. There would be a limit on the deficits of governments in countries that would join the monetary union. And it looks, the 3% that was mentioned there and that appears then as one of the criteria for joining the European Monetary Union in the Maastricht Treaty and then gets eternalized in the Growth and Stability Pact for members of the European Monetary Union. That 3%, it's easy, I think, and it was at the time discussed, isn't that rather arbitrary? Why would you want to bind yourself to 3% rather than 2.5% or 3.5%. But 3% actually came out of a calculation from the early 1980s by Jacques Delors when he was finance minister in France. France had a period of radical policy experimentation in the first 2 years of the Mitterrand presidency in 1981 to 3. And then there was a question at the end of this period of experimentation whether France should depart from the European monetary system, the fixed exchange rate regime that preceded the European Monetary Union, or whether France should stay in. But if that in that case, what kinds of reforms were needed? And the 3% limit on the budget deficit is the calculation of the maximum room for maneuver that the French budget would have in the fixed exchange rate system. And it was then taken up, and the very influential president of the German Bundesbank then puts this 3% forward in 1988 in the meetings of the Delors Committee, and it feeds its way through into the preconditions for membership of the EMU. Because there was a very explicit discussion of whether markets are capable of disciplining governments or whether some kind of self-discipline is needed. And the general, this was discussed as a thesis, and some people said, yes, well, all you need to look at is the market rate for the government bonds, and you will see when government borrowing becomes impossible. And the majority of people who thought about this in 88 and 89 said, no, markets won't actually work like this. They'll allow the financing of government debt at excessive levels for too long, unless you produce some kind of limit to that. So that was the first problem that had a slightly unsatisfactory solution, because the Growth and Stability Pact was then in the 2000s systematically violated, and the European Commission retreated from this, and the big countries, France and Germany, retreated from it. So it was imperfectly designed in that sense. But the second area seems to be much more crucial. If you have a monetary union, and if capital is going to flow freely through all the bits of the monetary union, if there are going to be big cross-border banking institutions, and that would be a likely outcome of the creation of the single integrated economic area, doesn't there need to be, in that case, a common European banking supervision and regulation? And this is exactly the issue that people are just discussing now. I mean, it's unbelievable that the real implementation of this is only taking place in 2012. And even then, because the crisis is a bit less acute now than it was in the summer, the pressure to reach an agreement is coming off, and so it may not even be that France and Germany are capable of agreeing on this right at the moment. But this was put in the original discussions that, yes, a future European Central Bank would need to do monetary policy, it would need to think about exchange rate policy, but it would also need to do banking supervision and regulation. Need to have a capacity to do that. And that, for me, is the greatest flaw of this, and the tragedy of why this thing is so unbalanced, and why, because you might say the fiscal rules don't do it alone, because some of the countries that get into difficulties in the 2000s had very, very good fiscal records up to the crisis. Spain or Ireland had good fiscal records, but Spain and Ireland had problems in the banking sector, and that would and could and should have been detected if there had been a common European banking supervision and regulation. So, originally in the, and this is sort of extensively documented in the book, originally in the first draft of the statutes of the European Central Bank, this is provided for. And then it gets watered down and watered down. And there's a kind of relic of it in the current statute, which is, I mean, it's interesting, but it's also significant in that it gives some kind of room for maneuver for expanding the European Central Bank into banking supervision and regulation, because under the terms of the statute as it was agreed at Maastricht, the European Central Bank can, if it's requested to do so by the European Council, act as a banking supervisor and regulator. And so it puts the emphasis on the action of the national governments organized in the European Council. Why didn't that take place? Well, I think there are two reasons. I mean, one is a kind of anecdotal reason, that the kind of story that historians love to tell. The institution that championed this approach most, and actually this is an interesting sub-theme of the story, that the UK played a very striking and quite positive role in many aspects of this process, that the Bank of England, for instance, agreed to the Delors report, even though the British government was really hostile to this under Mrs. Thatcher in 1989. But this was the model of financial sector supervision that the Bank of England had. And so they wanted really basically to export their model on the European level, and there was a substantial amount of support for that. There was also a substantial amount of opposition. The German central bank, in particular the Bundesbank, always had a tradition of not liking to do financial sector supervision because it envisaged that there was a possible conflict of goals, that there might be a moment in which, if you had banking supervision responsibilities, you would be obliged to do things on the monetary policy front that would threaten what the Germans thought of as the primary goal of a central bank, namely providing for price stability. So the Germans are opposed to it, but there's a good argument why it should be done. I think pretty compelling argument, really, why it should be done in retrospect. But then, just at that moment, there's a major scandal that erupts because a Luxembourg headquartered bank, the Bank of Credit and Commerce International, but a bank that did most of its business out of London, the City of London, BCCI, blew up. And the failure of BCCI pointed to the fact that the Bank of England hadn't really been doing proper financial supervision and regulation, and it rather weakened the case. And the man personally who had been pushing this at the international level, Brian Quinn, was also the man who should have been really responsible for supervising BCCI. And so that really discredits him. And it also leads, in 1997, the long-term fallout of BCCI domestically leads the new government, the Labour government in 1997, to say, actually, the German model is better, in which you separate banking supervision and regulation. And so the Bank of England then, in 1997, under a new act, is independent but gives up banking supervision and regulation. And the consequence is that the Bank of England is really out of the story in terms of the big financial bubble of the 2000s. So it was a mistake internationally. It was a mistake in British terms as well. And it's produced by, I think, just a kind of unfortunate chain of events. But there may be also a broader reason why the German argument on this in the early 1990s was convincing, and that is that the question of having banking supervision and regulation also implies a question: what happens if that fails, and if there's a failure of a big financial institution and a need for a resolution that requires then some kind of money paid by taxpayers. The problem is that the European community, which becomes the European Union in the early 1990s, doesn't have the fiscal capacity really to do banking resolution. And so without a big fiscal capacity, or at least some kind of fiscal capacity, it's hard to imagine bank resolution taking place on a European level. But if there are cross-border banks, then you really should have a capacity for bank resolution. Otherwise, it gets to be a very, very complicated business dealing with cross-national banks that are failing and that need to be recapitalized. And we've seen some of this in the aftermath of the financial crisis. At the time, in the early 1990s, and that's another kind of little side aspect to the book, nobody thought that the European Community budget would stay at about 1% of GDP, which it was then, is still now. And Delors, when he was thinking about what would be needed for a monetary union, was actually talking also about a 3% of GDP capacity of the European Union. And 3% seems to run like a red thread through this story. But this is another 3%. And 3% actually is historically interesting because 3% was exactly what the federal budget of the United States was in the 19th century in peacetime. So in a functioning monetary union in peacetime, the United States government, the federal government, was not very big in the 19th century, of course, but it was bigger than the EU is today in terms of its fiscal capacity. So this is a story that has a kind of emphasis that there was a real sense in which the Europeans were providing something in the monetary union that was actually a contribution to global stability and was an answer to a problem of the international monetary system, but that it was imperfectly realized. You might want to ask, well, where do you go from now? I don't really give very much of an answer in this book, except in a little sketched out epilogue, because the archivally based story really comes to an end in the 1990s. And but I think in terms of reflection on the topic, it's actually good to think about those consequences and that aftermath. One of the things that struck me, the very final chapter of the book that is deals in considerable detail, it deals with the kind of crisis that blew up in Europe in the early 1990s, in 1992 and 1993, in the exchange rate mechanism, in the fixed exchange rate regime that preceded the euro, and that actually threatened the realization of the euro project. And it seems to me that actually you can see some lessons from that crisis. It started off with a question, should one country get out of the exchange rate mechanism or not? Should Italy get out of the exchange rate mechanism? But very, very quickly, when Italy got out, it was clear that the problem wouldn't stop there, and that within days the UK was forced out of the exchange rate mechanism, and then Spain, Portugal, and by the summer of 1993, the speculative tension affected even the Franco-German relationship, which was always the key central driver of the European monetary story. And it was solved by what looked like a kind of counterintuitive solution of much greater room for exchange rate movements within the European monetary system. Instead of moving within a very narrow band of 2% fluctuations, you move to 15% fluctuations either way of a central exchange rate. And that seemed to be wide enough to allow any kind of speculation to be defeated. You know, when people ask me now, are there any lessons from the book about how to deal specifically with the European crisis of today? I would say, well, it's partly this banking supervision story is absolutely central to it, but also in a crisis, when you're actually in the crisis, you need some kind of measure of additional flexibility, and you need to think about ways of getting additional flexibility. And I can think of some ways of doing that. I obviously don't want to take up a lot of time sketching those out, but you can think of more flexible monetary policy in some ways, because one of the assumptions of the monetary union was that there could only be a single monetary policy and a single interest rate. That's basically right. But in a period in which monetary policy is getting more and more nationally segmented, it's possible to think of national variants, that you could have different collateral requirements, for instance, for lending in Spain to Ireland to Germany. You could even go further in the way of flexibilization. I would include under flexibilization possibly also allowing parallel currencies to exist. There's nothing really in the logic of this that stops you having a parallel currency. And in some ways, to get more flexibility, this may be needed. But those are really speculations. I mean, what is clear, I think, is that to deal with the crisis, more flexibility is needed, and the rigidity of the system as it was is something that makes for a proclivity for a crisis. But finally, one thing that I think you might take away from the book is this reflection of the link between what happens in Europe and what happens in the rest of the world, because this is a model of how economies cooperate and how a common monetary system is created. It was for a long time thought of as something that would be a helpful model if you're in South America or in East Asia or in the Gulf. People experimented with various forms of moving along this European path. And that it does seem to me that at the moment, Europe is a kind of what I like to think of as the canary mine of globalization. That is, the weakness of Europe, if Europe really allows this experiment to disintegrate, that sends shock signals not just to the Europeans, but to the rest of the world as well. And that's one of the reasons that I think we should take the euro crisis and the attempt to solve it now quite seriously. Thanks so much. Yes, please. Yes.
I would like to ask you, maybe this is more a comment than a question. If I think that your main argument is that in the 90s in the European monetary system, that crisis it was solved by giving more flexibility to the European monetary system. But then the question is, if you privilege the economic rationale for having the euro, why after that did member states go for the euro? Because the euro implied less flexibility and not more flexibility. So there's something that I'm missing there, taking into account, the crisis of the beginning of the 90s with the European monetary system. There's something that I not quite understand there in your argument. And the second question would be, I totally agree with you. I think that what the euro needs now is a measure of flexibility. But how do you get to that measure of flexibility without blowing up the whole project, the whole euro project?
So the first question, why doesn't the EMS crises, why don't the EMS crises of the early 90s destroy the logic of European integration, and why don't people learn from this that it's simply impossible? Well, actually, they see that there are elements of irrational speculation in the EMS crises. I mean, for instance, in this particular central issue of the franc-Deutschmark exchange rate, the introduction of the wider bands leads to a big fluctuation of the French franc, and you can see the consequence, for instance, of a presidential election on that. But in the end, after that period of turbulence, the French franc is almost exactly at the same position relative to the Deutschmark that it was before July 1993. So it indicates really that here there's an indication that the speculation is missing. The big question, why is it attractive? It's attractive particularly for South European countries to join this because it lowers their borrowing costs very dramatically. That's really the big story, and that's why the financial supervision is so important to this, because if you're faced with this fundamental change of the credit conditions of a country, you're very, very vulnerable to have big real estate booms and explosions of credit, why it would have been better to have done that. Why isn't there so much of a problem in the 1990s and the early 2000s? Well, it's to do with this long-standing issue that I think is central to the European discussion of the German current account surpluses. So the Germans regularly go into these phases of current account surpluses. One of the figures of the graph, the book tries to show you this story of why it's that that's driving things to a substantial extent. But in the 1990s, there were no German current account surpluses, and so the whole position is much less problematic because of the aftermath of German unification. So as long as Germany is spending really a substantial amount of resources in this big internal project of reconstruction, the German current account surpluses don't reappear, but they do reappear in the 2000s. They're financed through the private sector, and that financing is what's the key to the difficulty. The question: Could you introduce more flexibility without blowing up the system? Well, that's exactly what I think is the purpose of any effective kind of policy proposal, because the fallout from the blowing up of the system in a chaotic way is obviously by definition pretty unknowable, but likely to be costly and very, very painful, and might have all kinds of repercussions, including for the functioning of other aspects of the European Union. So it's the reason that I think it's thought to be desirable to avoid that. Andy.
Great book, by the way. I recently read it. So I'm confused still by the first question, I think. So why are European countries, particularly Germany, in your account so short-sighted? And so you dismissed two of the common accounts, I think, rightly. One is that they didn't know what they were doing. So you said people did know what they were doing. And secondly, that they did it for political reasons. So as you know, lots of people now have argued that it wasn't political. I think that's increasingly an established view. So there has to be an economic reasoning behind this. And then you dismiss the notion that Germans are thinking about trade surpluses as well as inflation. Why? And I'm not clear why you dismiss that. Instead, you say that can't be it because that would be short-sighted. But short-sightedness is exactly what we're trying to explain. Right? We're trying to explain why countries got into a system that turned out to be sort of short-sighted. Your explanation is that they were concerned about the euro-dollar exchange rate, which is right, the Deutschmark-dollar exchange rate in those days. But why were the Germans concerned about the Deutschmark-dollar exchange rate? Not in the long term because of inflation, because if the exchange rate went up, the inflation might go back down. But because for Germany, the Deutschmark going up is a disaster. Why? Because of exports. Right? So exports play a crucial role in this story, and if we don't believe it at the time, we can see the consequences now, right? This is a country running, the world's largest export surplus or second largest export surplus. So I'm wondering why you're so quick to dismiss what seems to be a critical factor and probably, according to most political economy accounts, the dominant factor in German foreign economic policy over 60 years, which is maintaining an export economy. And if that's not the explanation, then what is the economic explanation of short-sighted economic policy?
So the question is really, what is the particular exchange rate that is of such great concern? Is it the dollar rate, or is it the rate with other European currencies? Is it the rate with the French franc? And the argument that I think is really at the heart of this is that it's the instability with the neighboring currencies that is the source of the problems, and that's not primarily a problem for German export industry, but it's a problem for the coherence of the European community as a whole, because, as you know better than I do, I mean, all kinds of things in the European Union are calculated on the basis of agricultural prices. This is part of the big story of this in the 60s and 70s and 80s. So every time you get a movement in the franc Deutschmark rate, you get a new problem of, either you're subsidizing or you're not subsidizing a particular group. But it has nothing to do with the export industry in general in Germany. It has to do with the way in which the exchange rate fluctuations within Europe would undermine the idea of the common project. And then you do get back to this idea. I don't want to underplay this, because it's clearly very, very important for France and Germany to get together, and that's there is a political drive to do that. I don't want to deny that. But what I think is very interesting is, in the early 1990s, in the aftermath of German unification, Helmut Kohl is obsessed with this issue, how to bind Germany into Europe. And there's a new biography of Kohl that's just appeared, and it makes a great deal of this. And it traces, the author is a big critic of contemporary Germany and of the euro, and it traces this to Kohl's mistake. But Kohl, in this account, absolutely doesn't want another war. But the obvious thing to do, if you don't want another war with Europe, it seems to me, would be to say, let's go ahead and have a common European army. That would absolutely prevent any kind of future war. And indeed, Chancellor Kohl likes that idea in the early 90s and tentatively tries to suggest it, but the European military absolutely clearly don't want to do that. They really don't want to have a common army, because they would lose all kinds of things that they have in their existing military system. But on the other hand, when he goes to the central bankers really do want to go ahead with Europe. And so the central bankers have a good reason for going ahead with Europe, and the political people follow that then. That's the simple line. I mean, it's not so simple, but it's I think the right historical account. Should I pass to Joanne?
It's on kind of on the same theme. So, in the end, it does seem like we're coming back to politics as an explanation for the creation of the euro. Since, Ken Rogoff was certainly not alone at the time, other than that, given the different shocks that these economies were subject to, that a monetary union didn't make any sense. And it was also clear, I think, that if the Europeans were to create a common army, that wouldn't have made the U.S. particularly happy. So, and when Krugman talks about the collapse of the EU, and I wanted to ask you too about this, he talks about it as not having economic, particularly and possibly economic consequences, but he always talks about it in terms of, well, it just would, destroy the idea of contemporary Europe as a political entity. So I guess I wanted to ask you to sort of say more about what you think the politics were that was involved.
So I didn't really want to say that politics weren't important, and that's I'm glad I had the chance to elaborate a bit in replying to Andy on that. But what I really wanted to emphasize was the kind of specific economic logic that pushes you into first of all, the fixed exchange rate regime in the late 1970s, and then when there's a perception that that's potentially vulnerable, because in the late 1980s, the character of the exchange rate mechanism changed, and there were no longer periodic adjustments, but it became more and more rigid. And so people inside it were worrying precisely about this rigidity of the fixed exchange rate regime. And so they say, no, this is actually leading to the potential for a big blow up, and so we need to have something that has even more coordination mechanisms and tighter rules. But there's a kind of economic logic that goes really parallel to the political logic, and is, I think, not all that well appreciated by Kohl. But what Kohl just sees is that there's a good blueprint to go ahead with monetary union, and it's plausibly laid out, and it's supported by all kinds of people in a way that the military side just wouldn't be. Sophie.
So you mentioned that the second myth was that Germany, that the monetary union would increase or consolidate German power. But at the time in France, at the end of the 1980s, and especially after the fall of the wall, there was a reverse myth that was being used in order to sell the idea, which was that it was a way for France to get the power back from Germany, and instead of having the Bundesbank decide everything, at least this time the French would be involved in the decision making, so they would get more power out of, and this was,
yes.
So how much of that argument have you encountered in your research, and did that travel outside of France?
No, I have encountered that, and I mean, maybe I should have added that to the myths that I was going to demolish, because it's, you know, it's clearly a myth, and you know, one of the things that I think I can document really nicely is the way in which the ECB really evolved as a kind of larger version of the Bundesbank, and you know, its philosophy. For instance, this issue of not doing banking supervision and regulation. The Banque de France would have been happy with banking supervision and regulation by a central bank, but the Bundesbank isn't happy. So the ECB is really a Bundesbank-like organization, and people say, in retrospect, it's, you know, one of the themes in German discussions. Well, isn't it possible that you know, Germany is going to be consistently outvoted in the ECB because it's only got one seat on the board, and then the additional representative of the Bundesbank on the ECB Council. So the Germans are going to be in a minority. So you know, you might say exactly that France and South European borrowing countries can lean on the ECB and push it in a particular direction, and you see that kind of argument made. I mean, Hans Werner Sinn in Germany makes that argument again and again, that, you know, the ECB did do exactly this. It gave the power to the South European borrowers, and you're seeing the aftermath of that at the moment. But I actually don't really believe that, because I just think central banks are they're legal institutions, and they're kind of created by their statutes. So, you know, if you ask what the statutes of a central bank are, you can see what it's going to do. But you can also see, I think, you know, in the way in which discussions work on the ECB, in the ECB Council, that it doesn't really, if you don't have formal votes, it doesn't necessarily matter if you don't have very many formal votes, but you have a kind of rhetorical power that's pushed by the way that the thing is created. You know, I mean, this is also quite interesting that many people in France in the early 1990s and during the Delors Committee as well thought that the Delors report and the aftermath of it was a kind of betrayal of traditional French principles. And there's something that I discussed there. I didn't discover it for the first time. It appears in Dyson and Featherstone, and also more fully in David Marsh's account of the euro. But it's a fascinating episode when the governor of the Banque de France, who's the member of the Delors Committee, he's summoned into the French Finance Ministry and given a kind of hour-long tongue lashing by the top permanent official in the finance ministry, with the finance minister sitting there and looking at this, Pierre Bérégovoy sitting there and looking at this. And, you know, the irony and the odd thing about it is that that permanent official, the Directeur du Trésor, who gave the tongue lashing to Jacques Delors, was Jean-Claude Trichet, who then, you know, comes in a later incarnation to be, you know, more Delorosier-like than Delorosier. So it's got a nice irony about it. But I think, and Trichet actually will say this, that if you have a unitary state, a centralized state, it makes sense for the central bank to be somehow dependent on the political will. In a federal state, where the federal authority is going to be more diffused, there's a much more powerful argument for an independent central bank, because you balance the influence of the different regions. And so the models of good central banking that have really evolved and that the ECB bases itself on are three federal states, the United States, Switzerland and Germany. And those are the three central banks that are most independent in the late 20th century and that actually do the best monetary policy. And so there's this argument about central banking going with federations that I think is quite interesting. Please.
I have a question that I think is a little bit out of the area of your discussion, but nevertheless very important. And that is the impact of fiscal policy or absence thereof in consideration of the European Union economy. Now, there's much talk about monetary policy, which is interest rates. There's very little talk, no talk about fiscal policy. Now, as a federation, each of those countries has its own fiscal policy of taxation. What impact does that have, if any, on the ability of each of the countries in the EU to survive and the level of their sovereign debt? What is the fiscal policy in Germany versus Greece, for example? Ability to collect taxes. We talk about monetary policy, we talk about austerity and expenditures, but I don't hear anything about fiscal policy.
No, there is a lot of discussion about fiscal policy, and I mean this is one of the areas where, again, before the crisis, there was some kind of discussion of it, and it was more academic, and people said, well, yeah, but it's working all right. And then after the crisis, there's more of a kind of sense of urgency in these fiscal policy discussions. So that's the parallel track, really, of the crisis response. And the question is, a 3% rule looks too rigid because you want a possibility of a dynamic response, so that in a recession you want to have more room for fiscal expansion, and in a sustained upswing you would want to have more requirement for fiscal contraction. And the problem really, in retrospect, was that the European countries didn't think that the boom period was as exceptional as it proved to be. So I think the fiscal issue, I mean, I think you're right about your observation about the book. Some people said that making the European Monetary Union, the title was a provocation, because officially in Eurospeak, EMU doesn't stand for European Monetary Union, it stands for Economic and Monetary Union. And so to say this is a title implies that there's strongly that the economic union really isn't realized, and I would clearly like to associate myself with that position. Please.
Yeah, so it seems that today we see quite vividly these, as you put it, flaws in the design of the European monetary system, so allowing fiscal and regulatory power to remain at the national level, whereas monetary policy is set at the European level. And so in your book on the creation of the euro, Kate McNamara argues that these problems were swept under the rug because there was this, the emergence of this neoliberal consensus, and nobody expected that there was going to be strong divergence cross-nationally on questions of fiscal policy or regulatory policy, because everybody was on the same page, right? Your story, though, is very different. You explode that myth and you said, well, people did know that there were these problems, and the framers of the European Central Bank tried to get the provisions in to prevent these kinds of things, to ratchet those authorities up to the European level. And then they didn't happen. They got watered down until they were eliminated. And so in some sense, I mean, your story is actually a little bit more disconcerting, because if they couldn't get it right in 1989, fully aware of the problems, right, can we be optimistic about their capacity to get things right in 2012, now that the divergence is 2 decades deep and the heat is on to make these changes in real time?
It's an excellent point. I mean, I think you're right that, if this was an aeroplane and it was designed like this, I wouldn't want to get onto this aeroplane. But, political institutions are not quite like aeroplanes. You can redesign them a bit as you fly. And, it seems to me that that's what they're doing. And, maybe there's a, as you suggest in the question, there's too much of a reliance on your capacity to do this. But it's deeply built into the European philosophy. If you go back to the 1950s, and Jean Monnet, there's a wonderful passage in Jean Monnet's memoirs where he says, one of his officials says to him, but surely, Jean, there will be, after one of these all-night sessions, negotiating sessions, surely there will be, this can't last, the agreement that we've concluded, and that it will blow up at some point. And Jean Monnet then says, yes, you've exactly understood the European method. That's how we advance. We need crises in order to reform. And in a sense, that is very acutely a problem even at the moment, because if you look at the kind of fever thermometer chart of the European Union or of the Eurozone is the chart of bond price divergences. And when the bond price divergences are great, people really get scared and they need to act and they need to do something. And one of the consequences of Mario Draghi's announcement in July of the intention to provide the big bazooka in the form of the OMT, the outright monetary transaction, has been that the bond prices have come down again. And so the sense of crisis has gone away. And we're looking this week, there's going to be another meeting in Brussels, but the general impression of that is that is less than urgent now. And so the banking union story is less urgent than it was in the summer because the sense of crisis has gone away. And when you describe it like that, you do describe one of the elements of the European mix that's unfortunate. It reminds me a bit. There's an old Austrian film called Wiener Geschichten, and the standing gag in it is of a waiter with an impossible number of glasses on his tray, and he's always tripping over something. He's tripping over somebody's feet or somebody's umbrella, but he always catches himself at the last moment, and so the thing is all right. But right at the end of the film, of course, he doesn't catch himself, and the glasses fly all over the place, and there's a big smash up. And it seems to me that big smash up is. It is one of the things that it goes back to the very first question. It may be built into this philosophy of how to manage crises. Yeah.
Just one request for clarification, and then a question about your advocacy of flexibility. Do your findings ultimately leave intact the notion that there would not have been the euro without unification? Because even though the reasons for the Delors report were economic, it would have gone the way of the Banner report and WO and so on if there hadn't been a different political context. Or is that the ultimate myth that you are demolishing? And the other question is simply this. So some of the official German proposals now for dealing with the crisis are of course exactly the opposite of flexibility. More rigidity, debt breaks in constitutions, absolutely fixed rules, and so on. And of course, one of the things that at least does, however flawed it might be, is to take the politics out of the equation on one level. So if flexibility is the counter-proposal, who decides when flexibility is allowed and when it isn't? Who becomes the kind of instance who has the inevitable word, the legitimacy in this context to make that call?
Excellent question, the second one. The first one, yes, that is exactly the intention of my argument, that I think German unification is actually a red herring in this story, but it does certainly increase the support of Kohl. But Kohl was already in favor, very, very in favor of the Delors project before the summer of 1989. So that's certainly what I wanted to say. And the second point, yes. In general, also, I think this question of whether you're dealing with a centralized state where there's a much greater room for policy inventiveness, or a federal state in which you need to have rules in order to determine the relationship of the different bits to each other, is central. So the federal states that I'm thinking of are potentially models for this. Germany, but Germany actually has a kind of unsatisfactory Finanzausgleich between the lender, and that gets into the political highlight when there are fiscal difficulties. Switzerland is better, and Switzerland really has a strong system of brakes on the capacity of individual cantons to do bits of fiscal expenditure. So in that sense, there are brakes on this system, but you have flexibility within this. And so I think the monetary policy area is easier to explain, but you certainly need this in the fiscal story as well, because clearly having a system that forces you to contract in downturns is so counter to any rational thinking that it's likely to be dismissed as absurd. And then when it's dismissed as absurd, it will be incredible, so it won't do any of the things that it's supposed to do. So in order to make a system credible, you need to build the flexibility in. It's a kind of design problem for federations, but it is surmountable, and it's surmountable, and I think actually very easily compatible with democratic solutions. And this democratic question is very, very important. But if people want a model for that, in the early 2000s. Switzerland introduced exactly this kind of system for its relationship with the cantons to the federal government. But being Switzerland, they had to have a vote on it. And 85% of the population, the largest ever positive vote in a Swiss referendum, sort of astonishing popular acceptance of this. So, the sense that you want to get a system that doesn't impose impossible burdens on your children and grandchildren is a very powerful driving force, and I think an attractive political argument.
We have time for one more question.
Please.
So the public perception and the communications that come out daily practically, there seems to be quite a difference between some of the southern countries like Greece and Spain and their economic situation, and Germany, French side. Do you see any way they can resolve this and keep the EU and the euro going?
You're absolutely right, but I think it even reaches into the German-French relationship. And I would just like to read you something from. I didn't read anything from the book, but I would like to give you a little excerpt so that you get a sense of how this was already a big theme. Long before the euro. In 1982, a letter from brilliant Italian economist Tommaso Padoa-Schioppa, he was one of the real makers of the euro, very, very interesting and creative person, to the head of the German Bundesbank. So he's telling, this is in the period when there's this French experimentation, so there's a big French-German divergence of this, and you might say at this moment that French and German philosophies are pushing in different directions. And Padoa-Schioppa says, to couple the defense of monetary orthodoxy with that of the institutional status quo may lead to defeat in terms of both monetary stability and independence. Your monetary constitution, he says this to the Germans, your monetary constitution has been too successful on the fight for stability. It will now either become the monetary constitution for Europe or be contaminated by the sins of the others. That is, by the way, a very deutsches Schicksal. So he uses the German word in an English letter. That's a very deutsches Schicksal. And the idea that Germany has to compromise and to get rid of this very inflexible thinking about how monetary policy mustn't be contaminated by financial stability. That's a core thought at that time, and obviously I think still to this day it's a core issue.
Well, thank you so much, Harold.